So I'm back. I don't have a question of the week this week, but I would like to talk about something. And I'd like to start off by talking about being mortgage ready. Now, before I dive into being mortgage ready, what I see a lot of homeowners do, or first time home buyers, let me just correct that. Um, they shop. They go looking on places like Zillow, Redfin, all these different websites looking for homes that are being marketed, and they see homes that they like, different areas, different prices, and then they say they want to go and look at these homes, go to open houses. And then in the process, at this open house, they may hear a question asked like, "Are you pre-approved, pre-qualified?" Then they're not. Then they decide they want to find out about being pre-approved and being mortgage ready. Um, Mortgage ready refers to the financial and the credit worthiness of an individual or a household that's looking to apply for a mortgage. Period. The steps of being mortgage ready requires that you have your credit in place. That's one of the first things. Your credit profile, meaning not just your credit score, but they're going to look at how you pay your bills. Do you pay your bills on time? Are you a person that chronically pay your bills, but you always pay them late? Those are things that they look at. Not to say that it will impact you from, getting a mortgage, but those things can be looked upon and can affect you in other ways, that would hurt you somewhere down the road, looking at the ratios of your debt to income, or basically the interest rate that you're going to be charged. Because the lower your credit score, the higher your interest rate. Very simple. The higher credit score, the lower the rate you're going to get. Meaning that you're credit worthy. You're a risk worth taking. When you're a risk not worth taking, they show it in the actual interest rate that they're gonna charge you. Um, what else is mortgage ready? Your credit, your down payment. How much are you coming to the table with? How much skin you have in the game. How much reserves you may be able to, hold on to in the event something goes wrong with the property. The little things that, underwriters look at and that they may not actually say. As I mentioned before, debt to income ratio, how much income you earn versus how much debt you have. If you earn $10,000 a month, but you paying $7,000 in debt, your debt to income ratio was pretty high. You only leave yourself 30% to even want to pay a mortgage, and no lender is going to give you, a mortgage on a debt to income ratio that high. So sometimes people think, oh, I make a lot of money. How come I can't get a mortgage? How much debt you have? Think about that. So we got credit, we got debt to income ratio, employment history is important, how long you've been on a job, down payment's important. No, those are some of the important things you got to look at. Those are things that make you mortgage ready. Do you have a loan officer? Do you have a lender? Do you have someone that can tell you, hey, this is how much your debt is, this is how much your income is, this is how much your debt to income ratio is, this is how much you can qualify for to go and now start shopping for a home. Now it makes sense. If I know that I'm only eligible based on my income to purchase a home that's $525,000, then why am I looking at homes that cost $600,000 and disappointing myself because I can't qualify for it? Are you mortgage ready? That's the question. Anyway, that's it for tonight. Thank you for your time. I will be posting this on my YouTube page called You don't know what you don't know. That's my page. Have a good night.